If you're holding crypto in 2024, you are losing money every single day and you probably don't even know it. I'm going to show you exactly why and what you can do about it. Let's dive in. Well, many of you have probably flocked to cryptocurrency due to rising inflation in your country, even in the United States. You probably don't actually realize that there is inflation in cryptocurrency assets as well. Now, I do want to be very clear right here. Some assets have more inflation than others, whereas some assets have manageable inflation and others don't even have inflation at all. Right now, I want to talk about Bitcoin for starters. Bitcoin inflates by approximately 1.8% per year. Now, that goes down every single time there is a halving, which is roughly every 4 years. We just had our latest halving back in April of this year. But if we were to put $10,000 in Bitcoin a year ago with an inflation rate of 1.8% per year, assuming there was no price appreciation for Bitcoin, that one Bitcoin would be worth $9,823. If we did that 4 years ago, that one Bitcoin would be worth $9,311. And just like the traditional economy, we expect Bitcoin to outperform its inflation by having significant demand, which it does have significant demand. The Bitcoin model does work, but the thing is, you are still losing money to inflation every single year, even though your Bitcoin is appreciating. Solana's annual inflation rate is roughly 4.9% per year. So for example, $10,000 in Solana 4 years ago, assuming there was no buying pressure whatsoever, would be worth $8,258 today. So while your portfolio may look the same, or it may even look better, it's actually losing money every single month due to inflation, and that inflation can be combated. Specifically on Bitcoin, there are some DeFi yield generation opportunities that allow us to get anywhere from 5% to 100% per year on our assets. Now here's the beauty of that. If we have 10 Bitcoin and we are generating, let's just say, an average of 50% per year, we are generating an additional 5 Bitcoin every single year, no matter what our Bitcoin is worth. So if our Bitcoin is worth half of what we bought it at, we are still generating 5 Bitcoin. Whereas if it's worth double what we bought it at, we are still generating 5 Bitcoin. The point is, we are increasing the actual amount of assets that we have as opposed to increasing the dollar amount. We let the dollar amount do its thing, right? We let it appreciate, but at the same exact time, we are generating income through DeFi yield generation strategies. So somebody that bought 10 Bitcoin at, let's just say, $50,000 will have $500,000. And when that Bitcoin goes to $100,000, which it's nearly at today, they will have $1 million. Compared to somebody that was investing into DeFi yield generation strategies, they would start with $500,000 and maybe they acquire 5 Bitcoin at an average price of $75,000. Because of course it takes time to acquire these Bitcoins, and during that time, Bitcoin is probably going up. Well, their initial cost basis is $500,000. They generated another 5 Bitcoin at an average price of $75,000, which means that's another $375,000 that they quote unquote put into Bitcoin. Even though they didn't have to deploy more dollars from their bank account, they generated more money, which is taxed. Therefore, meaning that their additional cost basis is about $375,000. That puts their overall cost at $875,000. But keep in mind, at the price of $100,000 per Bitcoin, they're not going to have $1 million, they're going to have $1.5 million, which means that their profit was $625,000 compared to the person that was just holding Bitcoin being at a profit of just $500,000. And I want to be very, very clear. You do not have to have 10 Bitcoin. You do not have to have $500,000. You can do this with any amount of money. You just have to decide what amount of money is actually worth it for you to do this with. So that being said, there are two types of cryptocurrency investors in 2024. The first ones are holders, waiting for their bag to appreciate, waiting for the market to do its work, and in all honesty, speculating on future price movements. And then there's investors. And I like to call them investors because they are investing their cryptocurrency assets into DeFi yield generation strategies. These guys are not just speculating on long-term price appreciation, but they're also generating short-term income. So that way, if that long-term price appreciation never comes, or that inflation keeps chipping away at their gains, they still have income that they can use to combat that. It's the same way that people invest into real estate. They don't make their riches from the $100, $200, $300 in cash flow that they generate every single month. They make their riches in equity. In other words, their house appreciating. Whereas that additional income is a buffer that they can use for any repairs, any maintenance, or just as cash flow. Well, the same exact thing goes for your cryptocurrency assets. Those assets appreciate over time, but what if you can also produce income from those assets in the meantime that you can do whatever you want with? You can live off of it, or you can invest it back into your portfolio portfolio and compound it so you can maximize your bull run returns. Now, obviously, there are risks associated with investing in your cryptocurrency assets, and I will cover those in today's video. But with that being said, there are risks when investing into anything. When you invest into real estate, there are risks. When you invest into the stock market, there are risks. When you even hold more than $250,000 in a bank, there are risks. It's just a question on whether you want to set yourself up for financial failure or financial freedom. So you'll notice as I'm browsing through these different opportunities, we have this APY that's displayed right here. We have these pools that are displayed right over here. And we have this project and chain that are displayed right here. The first type of risk that you're going to have is the chain, right? Now, if you're just holding your cryptocurrency assets on a centralized exchange, you have more risk than just holding on a specific chain. Now, there's not really many risk associated with holding on a chain, mainly because we're primarily investing in top chains. And there are different chains out there, like the Bitcoin network, the Ethereum network, the Solana network, where people can interact with different cryptocurrencies on these networks. So once again, there's not much additional risk by holding on these chains, because typically if you're holding on a centralized exchange, your custodian is already holding on a chain. And of course, they are your custodian, meaning that they actually own your crypto. You just have access to it. So again, chain is not a huge risk unless you're going with newer chains like, for example, Starknet, or older chains that often have issues like Phantom. But holding on Base, which is fully backed by Coinbase, that's not a problem. Holding on Ethereum, which is the largest smart contract network by capital invested on it, that's not a problem. Or holding on the Solana network, that's also not a problem. Next off, we have these projects. Projects are ran by smart contracts, and smart contracts essentially are coded in a manner where they say, if you deposit into this position, you will get a receipt for that position. And as long as you have that receipt, you can get your capital back. It is not putting your money in the hands of Aerodrome or Uniswap or Orca in these examples, but rather it's putting the money in a smart contract. People can go and trade through that smart contract and generate fees for you, and those fees go back to you. Aerodrome is not a custodian. Uniswap is not a custodian, but rather they are facilitator for these smart contracts, and they are developers that build these smart contracts. So again, there is risk there, and smart contract risk is arguably one of the biggest risks that you will take on. But to get returns like 50 to 100% per year, it's in all honesty worth it in my opinion. Now guys, before we dive into the next risk, I want you to drop a like and subscribe with notifications turned on if you are finding this video informative. Additionally, we have resources right below this video that will teach you exactly step by step how to dive into the DeFi industry as a beginner. Now the next risk is going to be the assets that you actually deploy into these pools, and it comes down to the price appreciation or depreciation of these assets, if they're going to go up or go down. But again, we're already taking on that risk the majority of the time because we're already holding the assets that we want to invest into these DeFi yield generation strategies. The primary risk here is one doing better than the other, and that is exactly why we select correlated assets. Because if Sol goes on a run, right, and Bitcoin stays the same, we are losing exposure to Sol because people are buying it, because that's how liquidity pools work. Whereas if they both go up equally, well, guess what? They're doing the exact same thing, therefore meaning that there is no selling because they're both performing the same. I want you to think about it this way. We are facilitating trades. We're allowing people to trade through a liquidity pool. So when we're doing a liquidity pool like Sol to wrap Bitcoin, if people are buying Sol, that's pushing the price of Sol up, therefore meaning that they are buying our Sol and they are giving us more Bitcoin. So we have to be willing to take on exposure to both assets in the liquidity pool. But at the same exact time, we can minimize the selling by selecting highly correlated pairs, and in all honesty, just making sure that the strategy makes sense, because a lot of the times the strategies don't make sense. So with that being said, if you want to learn about how we're transforming cryptocurrency holders into cryptocurrency investors and start generating anywhere from 50 to 150% per year, make sure to check out the link right below this video. We have some information there, but also drop a like and subscribe with notifications turned on, because I will provide some more information on DeFi yield generation strategies this week.